We are live. And Chase, you're still in downtown. You're in Nashville, right?
I'm in Nashville indeed.
There's still a lot of cranes in Nashville, very quickly growing
Oh
city.
yeah. It's as crazy as ever it seems. I mean, supposedly I guess things slowed down, but it doesn't really feel like it in Nashville. It's pretty crazy these days.
Yeah, I remember, like when Nashville first started growing, like the Gulch and like some of the surrounding areas, but those are also built up now. I'm assuming that the city's just kind of expanding, outside of downtown.
Indeed. And even in downtown, yeah, there's just new pockets. These days there's this big East Bank development where they're building both the a second Titan Stadium, very much underway right now, but also kind of a $10 billion multi-year project down the river.
Oh, that's very cool. Awesome.
Did you ever see Taylor Swift walking around?
I have not seen Taylor walking around lately. Many years ago, I think it was a lot more common. These days, uh, we would know because there would be a hive of people following. That is for sure.
Rob, she's hanging out in Cleveland now. With our guy Kelsey. So they were in Cleveland. They were in Chagrin Falls a couple days ago. So it prompted a lot of speculation that Taylor Swift could be moving to Cleveland.
Doesn't he play for Kansas City?
He does, but he's a diehard Cleveland guy and still lives here. So
Interesting.
Okay.
I uh I know somebody who works for MERS who has a place in Kansas near where she bought a place for during the football season.
okay, to just kind of hang out for Chiefs games. So
Yeah. Big deal.
yep, yep, yep. So all right, well, let's go ahead and get into it. This is the big picture, presented and sponsored by our friends at Depth. For nearly 2 decades, Depth doing such a great job pairing their strategic muscle, deep market fluency to really craft stories that matter for fintech firms in the mortgage space. If you need a PR partner built to keep up with the pace of today, nobody does it better in our space than Depth. Phenomenal job, and you can check them out at depthpr.com or on LinkedIn, or just get a hold of Rob and I. We'll connect you with Carrie and Leslie and Lindsay there. Phenomenal team over at Depth. So I want to thank them. And as always, joined this week my esteemed colleague and co-host, back from the Western Secondary. Anxious to get your thoughts on that in a moment, Rob. It is Rob Chrisman. Rob, great to see you, and welcome back to town. You're on mute.
I haven't looked. How's the Cleveland baseball team doing these days?
They're on fire. We thought they were dead, and they've made a great resurgence these last few weeks. So yeah, they're back in the playoff race, just teasing us most likely, but we'll see what happens. So
Well, good. Good luck to you.
here we
And
go.
they're the Guardians, right? Not the Indians yet.
They are the Guardians, even though, yeah, Trump tried to, pressure them to change the name back. We're still the Guardians. So
All right.
this week, very pleased. Our special guest this week, the CEO of Built. It is my friend Chase Gilbert. Chase, great to see you, and thank you so much for coming on the show today.
It is great to be here. Thank you for having me.
And if you could, Chase, for those our listeners and viewers maybe not familiar with Chase, with Built, if you could give us a little bit of
With both.
overview of the company and what you guys are most up to and into these days.
Happy to. We're a technology business really focused on solving kind of important problems in real estate, and very specifically real estate finance. We work with lenders to help them manage various aspects of kind of the real estate or construction loan life cycle. We go very deep into construction lending, which I know we'll get into today, helping manage construction draws and the portfolio risk that comes along with a very unique loan product. We have another division of our company that actually works directly with kind of the owners or developers that are using the proceeds to ultimately build the communities around us. They too have lots of challenges as they manage to a budget and need to pay vendors as they build things. And we also work with contractors. And so we have software products, we digitize payments, and then we have marketplace products where we kind of help people spend money smarter on buying a lot of the things they need to buy as they either make loans or build things.
Love it. Good stuff. And really excited to get into it today with you, Chase. Construction lending, something we talk about a lot on this show. It's something that
Yeah.
really, a huge part to just kind of fixing housing finance and the housing finance infrastructure in America. And yeah, really excited to get into it with you today. So.
I'm excited too. I like to nerd out on this stuff. I know you guys do as well.
Love it. So, Rob, a few things. So, one, I want to get your thoughts on Western Secondary as part of your retort here, how that was the beautiful Terranea Resort, one of my favorite places. And then this week we got inflation data, wild inflation data this week. CPI Tuesday morning, tamer than expected. I mean, especially if you take out shelter related costs. But then we get CPI this morning, which is really, really elevated. So, painting
TPI.
or PPI, I'm sorry, yeah, PPI this morning. So painting a picture of tariffs impacting companies and producers, but them not passing it on to customers. And then, of course, the ongoing Fannie Freddie, will they or won't they take them public? Debate that kind of keeps raging on, and federal government looking into selling estimates of between like 5 and 15% of their stock in Fannie and Freddie to bring in 30 to $50 billion, and while leaving the implicit guarantee, but making the GSEs once again, I guess, like quasi private. So with all that, Rob, once again, no shortage of topics to attack, and we'll see which way you get us rolling this week.
So it's interesting. The Western Secondary, it was a very good conference. It was well attended, over 750 registrants. And I would say that most people who were there were registered, unlike, say, the National Secondary in May and for the MBA in Manhattan. So because Terranea is relatively isolated, so you kind of had to, if you're going to stay there, you had to, be involved. The mood was good, but cautious. Probably a little more cautious, maybe because capital markets people are just cautious people. We're all kind of like librarians a little bit, nervous. But the general feeling was somewhat optimistic, but it was interesting because one of the folks there was from JP Morgan Chase, involved in capital markets, and he was saying that their pipeline in July, 70% of their loans were adjustable rate mortgages.
Hmm.
Okay. 70% of Chase, of JP Morgan, however many zillions they do, 70% of the loans were ARMs, were adjustable rate
How
mortgages.
is that even possible, right? I mean, Chris Bennett, though, was on a couple or last week, and he made the same comment that he's seeing a lot more, ARM activity flowing through the secondary markets, but 70% for Chase, those are just really hooked
Right.
on straight lending. Maybe that's it.
Yeah. So you've got that figure going on, and then you have a situation where, and I receive emails from people. You have to think that the other big banks, the Wells, the Cities, B of A's, they're probably in the same ARM boat, adjustable rate mortgage boat. The excuse me, the uh, the latest statistics that came out yesterday morning from the MBA showed that 46% of the applications from the week before were for adjustable rate mortgages. Okay, so almost half of new apps. So it's a thing. And so one of the big discussion topics that we talked about at the Western Secondary was you can have a situation where in September next, which is now next month, the Federal Reserve Open Market Committee reduces their rates. There's probably 80 or 90% chance, I think, at this point of that happening. Now the debate is, oh, is it going to be a quarter or a half? But the long-term rates, although they've come down a little bit, haven't moved as much. So short-term rates down in anticipation of that. Once again, the bond market is predicting what the Fed is going to do. So short-term rates have dropped. Long-term rates have come down a little bit, but meant that's meant that the yield curve has steepened. Difference between short-term and long-term rates gotten steeper, and therefore ARMs look more attractive to a potential borrower than a 30-year fix, especially 3-1, 5-1, 7-1. That's a great selling point if you're a loan officer and the borrower comes in and says, "Well, I think rates are going to come down." Well, you know what? Buy the place now or refinance now, put you into a 5-1 or a 7-1 or a 3-1 or whatever. And when rates come down per your prediction, we'll refinance you into a 15-year or 30-year fixed. What are you waiting for? I mean, it's a great sales point if you're a loan officer. However, I am now seeing emails from mainly from independent mortgage banks, but also from brokers. Who's got the hot hand for adjustable rate mortgages? Who can I sell? Who's got the best price out there? Well, as always, the best price are the retail branches of banks and credit unions. There's not a lot of correspondent appetite or wholesale appetite for that matter for ARM loans. And so right now, heading into the autumn, if the yield curve remains steep, the advantage will go to or keep going to the credit unions and banks who have, deposit money that they're paying, very low interest on, and they can offer these ARM programs, some portfolio products, others are securitizing, but the ARM market is good, and generally brokers and IMBs don't do great in an ARM market.
It's true.
But
And one follow up on that, Rob. I mean, it's, having worked for banks for 20 years, love ARMs, man. Great for the portfolio, very, very little interest rate risk. Delinquency on residential is very low. It's just, at the same reason it's tough for banks to put fixed rate on the books. ARM's great for the books, and it's good to hear that the ARM market's more vibrant. And Rob, it's in my mind, it's got to be because, right? And you would think the secondary market might catch up because I think most people feel like we're not going to be going down to like 3 or 4% on a 30-year fix. That's like the nightmare, right, of an ARM purchaser because that stuff's going to pay off and refi, and you're not going to get your investment worth if it pays off too soon. Do you think do you think, Rob, that, an increased belief in kind of like a higher general rate market for the next 5 years will help bring more aggressiveness and competitiveness to the correspondent secondary market?
well, um, so I've been doing this 40 years, Rich.
Hmm.
I have yet to see any kind of appetite in those 40 years in the secondary market for ARM loans. They keep waiting for Fannie Mae and Freddie Mac. Oh, when are they gonna start really buying adjustable rate mortgages?
Hmm.
When are investors really gonna, when will this happen? And I've never really seen it. It's the same complaint year after year or business cycle after business cycle where there's just not enough investor demand, and the banks and credit unions get enough product from their own branches.
Yeah.
They don't need to go out and buy ARM loans, and AmeriHome, companies like AmeriHome or PennyMac, Freedom, they just don't have the appetite. So, yeah.
And Chase, really curious to get your thoughts, as the CEO of the leading construction finance technology platform in the industry, just your view on just the general state of the construction lending market here in America, and maybe any thoughts you have on, what the look forward in the short to medium term could look like.
Happy to. So let's start with, we get the vantage point of working with a little over 350 bank and non-bank lenders that are active in construction lending. And that spans everything from owner-occupied consumer, like renovation and construction to perm type mortgage products, through to home builder finance, land development, from like one-off spec homes all the way to very, very high volume home builders. and even into the commercial world, including kind of multifamily office, retail, mixed use, industrial. So we span across that. And what I will say is like the last few years, uh, brutal in some sense that, and it's hard to actually assess how much of it is demand related versus really supply of capital related. A lot of our clients pulled back the reins on their appetite for continued origination volume and figured they would kind of digest what they had done. And so in some ways, I feel like there was actually more demand for the loan product than there was supply of capital, which is kind of an interesting phenomenon. I'm watching that change. So anecdotally, we spend a lot of time with our clients and hearing things like their pipeline year over year is up anywhere, 100, 200, 300, 400% year over year, which tells me kind of the owners out there, potential borrowers are, clearly things are either penciling out if it's B2B transactions or if it's consumers, people are deciding, you know what, I do want to go build my home. I'm dissatisfied with current available purchase inventory or the, new track home that some home builder built. And it's driving kind of but the pipeline up, but we're also seeing it kind of transcend over into closed deals. So our client volumes are definitely up. Um, but I do feel like it is interesting to try to figure out. I don't know there's a perfect way to do it to really assess whether it's because they know that lenders are lending again. Like in multifamily, I feel like there was so much of it in 21, 22 that it went kind of pencils down for quite a while. Um, we are seeing because people know these projects can take 18, 24, 36, even 48 months to really build up and ultimately deliver. Because of that, they know the time to do it is really now. And I think a lot of people for a little while, I think something Rob said earlier related to that conference was kind of the cautious optimism. That's the term I keep using and hearing from our clients as well. That, um, for a little while, I think there was a lot more nervousness on maybe consumer recession, and nobody wanted to go break ground on some big project if they were going to deliver it potentially in the middle of a recession. I think that has felt like it started to wane. And like we're seeing projects get greenlit. Of course, it's market dependent. Every market's its own animal. In Nashville, there's still a lot of inventory absorbing, where I happen to be based. But people acknowledge, like, well, 36 months from now, though, we're going to need new inventory coming online. So, long-winded answer to your question, but we're definitely seeing it kind of across the board. It feels like volumes are up.
Yeah, and I would agree. The optimism shift, even like this morning, like we got a bad PPI number this morning, and the 10-year went up a little, but not as much as I thought it would. Stock market tanked at first, but it's kind of fought back. So it does feel like the sentiment is kind of changing. Chase, on the regulatory front, though, I know, like depositories, there's
Yep.
at least a lot of risk to them in construction lending, or perceived risk, interest rate risk, and a little bit of credit risk when you approve the person, you start building the home, and
Yep.
you go out and buy Lambos. Um, and then you've just got like the regulatory cost piece of it too. I mean, how do you think that lenders view, risk right now? What are the biggest blind spots you think they have as it comes to managing construction risk?
Uh, for sure, what comes to mind is the best time to manage construction loan risk is before you've made the loan. And actually understanding the construction project that you're lending against. Uh, when someone comes, so whether it's a consumer or whether it's a business entity, kind of underwriting them, putting that to the side. But if you think about the nature of a construction loan, you're lending money to someone where the asset does not yet exist, and someone has created a budget that is hopefully enough money to build whatever it is they're building, is hiring a contractor, many subcontractors that hopefully have experience building what it is you're building. But you also go into it eyes wide open that statistically, the vast majority of projects don't finish on time or on budget. So therefore, That is not what, if you're a lender, that is not what you want to hear. And so I would say the biggest blind spot is really related to lenders are lenders, and very few of them are construction experts. So I think a lot of it is when you get plans, specs, the budget itself, a copy of the contract with a contractor, if we're talking consumer lending, all of that stuff, actually either having someone in-house that does know what they're looking at and assessing whether or not this is going to be sufficient budget to build the thing they're trying to build in the amount of time. uh, that's the biggest gotcha that I see. And you can solve a lot of your heartache just on the front end before you make the loan, or having kind of a sufficient contingency reserve. For instance, with inflation, that's gotten a lot of people where, costs kept going up, 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 and next thing you blow the budget, when maybe when they made the budget, it would have been sufficient were it not for costs continuing to rise. So I think you just have to be kind of thoughtful on that. The next thing, like let's assume you've actually made the loan. I think um, ongoing surveillance of the asset and construction. I think that's another one where hopefully for all the lenders out there, if you're making construction loans or certain renovation mortgage products, you're actually validating the money's going where it's supposed to. And we can unpack kind of tools to do that better. But I think that's another blind spot. Things like ongoing monitoring for any involuntary liens put on a property. So those are usually surprise moments where there's now technology where you can tap into most local municipalities and understand if any liens have been put on a property, not just at the closing, but ongoing through the course of construction. Things like that, I think, can help you identify problems before they get too out of whack. Of course, the worst case scenario is you continue to fund a construction project where the money is in fact not going into the asset that is your collateral. That's everybody out of the water. You've got a big problem. Whether that's like a fraudulent event or sometimes it's honest mistakes from naive people that haven't navigated construction before. But either way, that's usually kind of your worst case scenario, and trying to do things proactively to mitigate that risk is, I think, uh, maybe, super wise. And there's your blind spots are typically there.
It's interesting, Chase, as usual, the one of the topics I heard at the Western was, hedging builder business, competing against mortgage competing against mortgage companies that either are part of the lender, I mean part of the builder,
Yep.
or just have like a long-standing relationship. And then how do you hedge something, 6 months out, 9 months out, and do it in a cost-effective manner, which, capital markets people sometimes when a recruiter for a company is out trying to get a new loan officer to come on board, the new loan officer say, well, what kind of builder product do you have? What kind of, do you hedge? I'm trying to get into this builder. What do you have for me? And that's another thing, Rich, that hasn't really changed in decades. And that is, the TVA market only goes out so far. You can only sell a mortgage-backed security out a number of months. And when you're dealing with a builder whose, timeline is more like 6 to 9 months or 9 months to 12 months, you end up trying to collect something up front and then using that money to put a hedge on and then roll the hedge out and hope the loan closes. It's a
Yep.
it's a tough situation. That's another tough situation for independent mortgage banks or brokers to compete with a builder that's already associated with a lender, compete with that relationship. So
Yeah, you're spot on. And, and Fannie and Freddie, we've talked about this many times. We're very close to rolling out a construction product. And, then the current director got in some trouble, and then the pandemic followed not long after, and it was kind of over from there. There had been talk about maybe Fannie and Freddie getting back into the construction lending game
Yep.
before the election. Now I can't see it just because they're going to be taking them private. Again, I think I'm still in favor of the GSEs going private, but I do worry about shrinking of the credit box, and could
Yep.
they be used as a utility if they were not privatized to help eliminate the interest rate risk portion for IMBs?
Yep.
Because you're spot on, Rob. I mean, that was the last lender job I had. That was my one of my main projects, like the last 6 months I was there, and that's what it is. You're taking hedges out 90 days out. You're rolling them forward. That's very costly, especially if a home takes 8 to 10 months to build. And like the best case scenario, like if everything breaks your way, like it's a break even, was at least my experience, and a lot of risk to lose. So that kind of makes it tough. Any thoughts, Chase, you have on just the Fannie Freddie stuff going on and how it impacts your business, construction business, housing in general in America?
You know, I think I'm also in favor of the go private, but it's admittedly, I think I'm way out over my skis when I even say that. I'm definitely supportive of, and you alluded to kind of I think there's been multiple attempts at really improving and really having a construction offering. It feels like the demand would be insatiable. Everyone wants it, but it continues to be fleeting. And I'm definitely supportive of that. I think ultimately helping more lenders offer construction product should alleviate some of the affordability challenges. More people, I think, would want the product, especially if you can kind of make it more mainstream. It's a fairly exotic, it's hard enough for the average person that's never even gotten a mortgage to navigate that process. I think obviously a construction loan or renovation mortgage product has its own, like, probably 10x complexities. So I am hopeful that at some point, and now maybe it's delayed to uh, post privatization. And to your point, though, if being private actually makes it harder for that, that would be interesting. It just feels like there's so much support for that product offering. I am personally hopeful that it ends up happening. Not even, maybe or maybe not. It's great for built. I think it probably could be, but it just feels like it'd be great for the country.
This is the big picture, presented and sponsored by our friends at Depth, founded nearly 2 decades ago by Fintech trailblazer Carrie Milam, supported by her phenomenal EVPs Leslie Colley and Lindsay Neal. Depthpr.com if you want to learn more about the way they help fintechs tell their story in the mortgage space. Chase, you brought up technological advances Rob, your hand is up.
Rich, you mentioned yeah, IPO or going public. I can buy stock in Fannie Mae and Freddie Mac right now, right?
Yeah, it's like 9.50 and $11 a share, I think. I just
So
checked.
do you know why they talk about an IPO? Because they're already public, right?
Well, it's just a tiny portion of the shares from the way I understand it. And the government controls like 90 some percent of the warrants. I think the chat will probably know more than me and will likely.
Well, I think the majority of it is owned by, Bill Ackman at Pershing and a couple large institutional investors,
Yeah.
who stand to benefit. But I'm tempted just to go, spend $1,000 and buy, 100 shares of each or something, just to say that I did it
Mhm.
and that I can do it. I think the term that I'm hearing more of is recapitalization rather than an IPO.
Yeah, then and I think that's what it is. I mean, I think even Pulte made a comment today. It was like, we're not going to sell that much of it. It's not going to be that big a deal. It's really people are going to be shocked at how little the impact is. So, I think they're going to, most of the the scuttlebutt is that they're going to sell like 5 to 15% of their stake in the GSEs. So yeah, we'll see what happens. But
What's that? What's the note from Gemma?
I don't understand Gemma's note, so what that means. But yeah, I was just looking at that as well. Maybe she'll
All
chime
right.
in and
Anyway, you were going to ask Chase about technology.
yeah, tech in the construction space. We've heard the Trump admin talk about this multiple times on the campaign trail and even recently where they just feel like the construction process needs modernized, that there's many ways to do that to bring down the cost to builders and that being a
Yep.
focus of theirs. You've played a huge role in modernizing the financing part of construction lending in America. I would love to know your thoughts on just construction tech in general, maybe AI's role and some of the
Yep.
product features you guys have rolled out recently and have coming to help kind of satiate that need?
So to start, construction as an industry, according to McKinsey, is the second least digitized industry in the world after agriculture.
Oh,
And but a fun fact is it's the only industry that is less productive today than it was 50 years ago.
wow.
And a lot of that, I don't pretend that like at Built we can necessarily solve all of that. There's lots wrapped up in that. A big part of it is kind of regulatory. It's even getting things entitled and zoned properly to where you even can build all of the red tape associated with ultimately getting to build something. Over the last 50 years, the screws have been tightened and tightened and tightened, so it's harder and harder and harder. That's a big kind of, I believe, component of why there is so much waste, and partly, you've also got one of the most fragmented industries in the world that fuels maybe some of the lack of digitization. But within what we're doing, in some ways, I actually feel like the lack of digitization became an advantage in that you could skip certain components. So at Built, we think a lot, and you referenced AI, so I'll jump into it. First, you have to build kind of a bit of system of record. Then I think there's opportunity to build system of intelligence. And then after that, now with agentic capabilities because of AI, you can even have like system of work where technology itself can do the work of people in many cases. And if you think about system of record, clearly for everyone that follows kind of the mortgage industry, whether it's on the front end, your loan origination system, which is your definite system of record, uh, clearly post-closing if you're servicing your own, but there's a servicing system that becomes system of record. But in the case of construction and construction loans, they're those loans will roll through those systems, but so much of the activity, because none of those systems were designed for construction lending and construction assets, where again, they're a moving target where you're funding against a budget as you complete construction and milestones. Uh, Typically, it lived offline. And so, one of the big things we saw was let's also build a system of record for construction lending itself and the budget, the capital stack, not just the loan, but if there's equity and other sources of funds, let's give them a place to manage that. Let's give them a place to manage the budget and inevitably changes that may occur through the course of construction. But let's not just be a back office system of record. The next component became how do you introduce collaboration? So construction loans are unbelievably collaborative between the lender, their borrower, oftentimes the borrower's contractor, third-party inspectors that go view the job site to validate work put in place, think progress inspections. Oftentimes title companies are involved depending on the state that you're in. You may need to re-endorse the title policy after every single draw. So there's lots of collaborators. And, prior to what we were doing, a lot of that was email-based communication, spreadsheets, and kind of PDFs flying back and forth between parties, which create natural information silos. So it means that uh, it's hard. It's an inefficient loan product to manage if you're on the lender side. So it's expensive to service those loans as a result. Um, it's it's also not a great experience for the customer. So if you're a construction borrower, you're requesting a draw and it's a black box. You have no idea where your money's when your money's going to come. It's slow, it's clunky. So what we introduced was really not just digitize the back office and get it off an Excel spreadsheet and complement the loan origination system and the core or servicing system that a lender might be using, but also extend out to the third-party collaborators. And if you do that and you get everyone operating off the same sheet of music, then the ability to accelerate the movement of money while counterintuitively enhancing risk mitigation because you can actually see where everything is at all points in time becomes easier for everybody involved in the equation. My last brief commentary on AI is, when we started Built, we certainly weren't thinking about all the advancements. We started Built, launched it 10 years ago. We weren't thinking about all the advancements that would hit us over the last several years with AI, but I look at them as just new tools. We now have new, amazingly powerful tools to rethink how we solve some of the same problems for our customers. Because what didn't change is if a lender's making a construction loan, what do they want to do? They want to lend the money they want to get paid back, and I want to hopefully give their customers a great experience, drive referral business or retention business with that customer, and manage key risks while they do that. And so that didn't change because of AI. Now it's just how they can do some of those things definitely has changed. So I think on the system of intelligence and system of work, that's where AI has really come in for us. How do we, because we now have context, because there is a foundational system of record now, help clients use their own data as well as supplement with other market data to make better risk-based decisions, identify new opportunities, deliver better kind of contextual experience to their clients, the borrowers. And then on the system of work front, what I'll say and tip my hat a little bit on where we're going. We are actively experimenting with agentic capabilities for processing draws. We have live in production with clients of ours, people that are testing agentic draw workflows where an agent can, in our case, this agent can perform 56 different types of tasks and actually process draws pursuant to a lender's policies and procedures. And frankly, they can do it not instantaneously, but call it 40 seconds on average, and can see things because it has stored memory. It can think back on every draw. It can think back to the loan agreement. It can think back to every inspection photo that has occurred to validate kind of progress and make a contextualized decision on whether you should fund a draw. There's no way that would have been possible without AI, which is more efficient, again, for lenders that are offering this loan product. Definitely creates a better experience for the customer, but it's a huge risk mitigation factor. So today, when humans are processing construction draws, which to be clear, I think humans can still play an exception management role, and they're certainly the ones managing the agents. Uh, no human being can have all of that in their brain at the same time. And so what's exciting for us is like, how do you help, make the loan product more profitable for lenders, more attractive for borrowers, and mitigate the risk? And I think AI is playing a huge role in that. We're in the early innings of living it, but it's super exciting times to see how it kind of changes the product delivery for ultimately probably the whole industry over time.
It sounds exciting, honestly. Like AI agents, honestly, for managing the draw process, it's like it seems like a great use case, honestly, for it. All the complexities that you mentioned in the chat, some mentions of that, a lot of stuff in the chat, some built clients, Zion's Bank and others, giving shout outs for the great job that you do over there at Built, because it is such a complex process. I mean, it is really a process that is ripe for technology to take it. As you mentioned, it's long, it's kind of inefficient. There's so many counterparties involved in the building of a home. To have it all in one system of record where people can see milestones and where we are and where we need to be to release the next batch of money. And so, yeah, kudos to you for the work you've done there along those lines, and excited to see what's coming. So,
Thank you. We are too. It's been fun. I think democratizing this loan product, I think clearly in home builder world and commercial world, uh, you know, people are familiar with construction loans. I think in the consumer space, uh, like I said, it's hard enough to navigate getting a mortgage if you've never gotten one. A construction loan where it's like, what do you mean? I have to hire a builder and get a copy of the contract. I need to have a budget when I don't even actually know what I'm looking at on whether this is enough money to build the thing that I'm trying to build. I've got a set of plans. I've got, all these visions of my dream home, but most people are naive to that process. And we view ourselves as like, how do we democratize making that easier for the lenders as well as the borrowers and every other third party that needs to be involved in the process, and hopefully bring to bear the latest and greatest technology that makes it easier and cheaper and more profitable again for everybody involved.
love it.
Chase, I have a naive question. You ready?
Shoot.
So the average housing stock, I think, in the United States is 40 years old. And so renovation loans, trying to keep that 40-year-old stock up to date is obviously soaking up manpower, soaking up financial resources, soaking up material, et cetera. Does Built have a product for that specifically?
We do. So maybe stating it back, do we only help with kind of ground up new construction versus for lenders out there offering kind of renovation, rehab, improvement product. Now, a lot of what you just said, if someone's getting a loan and they're not just doing that with equity, it's often a HELOC, and usually in that there you don't necessarily see construction draws the same way but for lenders that are, if it's more material, if it's either like a more substantial renovation, uh, I do often see people get construction loans. They're just not ground up construction. And we have, on the owner occupied side of what we do, probably 20% of all the volume on built today is renovation rehab type work.
Mm.
Um, and you're going to see fewer draws typically. There's not, it's a shorter process, although some renovations can be quite substantial for those that have navigated them. Um, but so yes, we are, our product is used for that. It's interesting. We're currently in dialogue with three different, these are prospects right now. They're current clients on the construction side, but they have been thinking about evolving their HELOC loan product to where for home improvements, even if it's not traditional draws, but they want to do a few site inspections, or solar was a big one where people were getting solar installed on their homes, and you want to have like an initial draw up front to purchase the materials, maybe a second draw at midway through kind of install, and then once they actually receive kind of the final kind of permit, if you will, from the local utility provider, they would maybe do the final stage draw. We have people using Built for a lot of non new construction use cases. And it does, for whatever reason, actually feel like we've gotten more inbound over the last year for that kind of use case than normal. Maybe too soon to say whether there's a reason for that, but yes, our product is used for that all day long.
Yep. All right. Thank you. Glad I asked.
Three different bipartisan bills active in Congress and kind of moving right now related to help for home builders. The Road to Housing Act, the one that we've mentioned before on the show that came out of Senate banking, 24-0 unanimous. A lot of elements in there to cut red tape for builders, modernize zoning, streamline environmental reviews, do more to promote and reduce the cost for modular and manufactured housing. The American Housing and Mobility Act proposes 3 million new units through federal funding in areas that would be high impact. And then another bill in Congress that looks to kind of loosen, restrictions on minimum lot sizes and boost the density for single family lots. So we'll keep checking all that, and hopefully that makes some momentum. And Chase, I turn back to you. Trends in the construction space. Build for rent has been a bigger thing as of late, obviously. Modular and manufactured home. I think everybody is promoting those types of dwellings just because they're more cost effective.
Yep.
Any other trends, or of those trends, things you see emerging or continuing to be more relevant in the near future here?
Chase, just so you know, I think Rich lives in a tiny home. So he's a big proponent of
This
that.
office is my whole home, actually. Yeah. So it's me and my French bulldog.
Well, I love it. What I will say is, yeah, so also tracking and following closely with everything you just said. Yeah, I think we've watched it show up in our client volumes, and it went from, wow, our first lender that we consider it kind of home builder finance, people that are getting, potentially very large revolving credit facilities to build model spec and pre-sold homes, kind of master plan communities. Some people call it project finance if you're actually even also helping them buy the raw land, navigating, putting road, water, sewer in, developing into finished vacant lots, and then going vertical. Maybe they sell off some. That we had been doing that for a lot of years. Uh, Probably right in the midst of in 2020 is when we started noticing more people talk about built to rent, and that in 21 certainly kind of emerged as even more popular. It went from like a client was doing it to 5 to 25 to, these days I would not be shocked if it's well over 100. And it's shifted from we saw banks doing it to now we see kind of private credit folks doing it. And so it feels pretty pervasive. I think again, people follow the money, and people realize that there is not enough housing inventory in a lot of markets. And if you can build high quality single family homes in a concentrated neighborhood, It's like horizontal multifamily. And so I'm not really surprised that that product offering has taken off. A lot of people, like young families, whatnot, want single family homes. That is something that I've just, I guess my commentary that's maybe unique is just we definitely have watched that become much more mainstream. And it went from people were asking us how they could set up built to do it to everyone has figured out how to do it. Um, Absolutely on the modular front, more and more of our clients seem to be leaning big time into that just as a more efficient mechanism to alleviate housing problems. Uh, I think I've said for years that it felt so obvious that the lack of lot inventory was a major problem. It felt like post-financial crisis, so much lot inventory. Well, two things happened. A lot of lot inventory got gobbled up by the bigger builders, and they also bought up small regionals and they bought up more and more to gain lot position. But also, if you think about who in the lead up to the financial crisis, who was truly making all the A&D loans to buy land and actually develop it into lots to go vertical and build housing, it was banks. And when you think about, I feel personally like the pendulum swung, where now the capital treatment of that loan product is very punitive. There's not a lot of incentive for banks to offer that loan product. And and so you either need to be really, really big, so the big kind of get bigger, but it's hard for small developers to go get the capital to create more lot inventory. And it feels fairly obvious in a lot of markets, like there needs to be more lot inventory if you want to actually make housing more affordable and more opportunity to build vertical. So that's one thing that whether it's government intervention, whether it's figuring out just how to solve that problem, that it's one of those, it feels a bit hidden in plain sight. Like yes, labor is also a factor and cost of capital and, material costs and inflation, all those are real. Um, but I think lot inventory is one that I've personally just felt like we need to do more to create more of it. And that will also help solve a lot of the downstream problems.
Love it. And Chase, this was fantastic. Really, really appreciate your insight on just a critical element of the housing finance system in America. You are right at the heart and center of it. And we really, really appreciate you making some time to come on the show and share your insights and expertise with our audience today.
Thank you so much for having me. It was awesome to be here and big fan. So I'll be watching you guys for all the future episodes.
Love it. And if you
Mhm.
are listening on the pod or watching on YouTube, we do the show live every Thursday at 3 p.m. Eastern. Always the chat, always very lively and full of good stuff. And go to chrismancommentary.com if you want to get registered for the live. You register once, you register for all of them. And yeah, hopefully we see you there. So, to our listeners and viewers here this afternoon, thank you so much for spending part of your Thursday with us. Rob, thank you as always for your insight and the report back from Western. Some good news on the ARM market, hopefully, and some developments there. And we'll see everybody next Thursday.
Thanks, Rich. Chase, Depth. Adios.
And thanks to our partners at Depth. And we'll see you all next week at 3 p.m. Eastern on Thursday. Have a great rest of the week and weekend, everybody. Take care.
Bye, everyone.